After a strong start to the markets in 2023, the expected volatility has returned. This has long been expected as investors were starting to get excited about a potential Fed pivot and Fed rate cut in the back end of 2023, but that is not likely to come to fruition. The fact of the matter is, the economy is starting to look shaky, but it can be confusing. On one end, you're hearing about thousands and thousands of layoffs, particularly in the tech sector, but at the same time, unemployment rate is very low. We're also hearing about strong retail sales, inflation that is still rising a little bit in the past month. However, consumer debt is starting to climb towards record highs. With that being said, I am always on the hunt for safe, reliable, high-quality dividend stocks to add to my portfolio. And in today's video, we are going to talk about 4 of the top dividend stocks to buy in the month of March. But before we do, can you do me a huge favor and click that like button down below, as that is huge for the growth of this channel moving forward, and I greatly appreciate it. With that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for yet another video talking about dividend stocks. Dividend stocks to buy in the month of March that are all trading at a great valuation. As always, I am a CPA and not a financial advisor, so make sure you perform your own due diligence before investing in any stock or ETF mentioned in today's video, as these videos are for educational and informational purposes only. With that being said, let's take a look at our first dividend stock to buy in the month of March, which is a REIT, and it is Simon Property Group, stock ticker SPG. Simon Property Group is a premier mall landlord, the premier mall landlord, and it is a name that has been in my portfolio for a number of years. Now the weighting has changed over time, but with the stock pulling back of late, it is looking quite intriguing and another opportunity for me to potentially add to my position. Simon Property Group currently has a market cap of $45 billion. The REIT was rocked at the start of the pandemic, falling over 60% in a short period of time as lockdowns were implemented, thus no one was attending shopping malls. However, looking at this chart, you can see just how resilient the company and the stock was as it rose past pre-pandemic levels in 2021. But over the past 12 months, we have seen shares fall yet again, down 14% in the past year and still down roughly 15% over the past 3 years, giving investors yet another opportunity to add to this blue chip REIT. Many continue to think malls are dead with the rise in popularity around e-commerce. E-commerce is growing each and every year, undoubtedly, but there is still a place for retail real estate properties. SPG is not your typical mall REIT. Instead, they are the premier mall REIT. Simon Property is made up of Class A malls, which is a classification based on their retail sales per square foot, essentially saying if you are a tenant, how well do you do in these malls? Over the years, SPG has maintained this A or A+ rated portfolio for a number of years. The malls that are dying off are mostly C rated or lower malls. Simon Property Group has a large footprint across the United States, with over 40% of their company's net operating income coming from the states of Florida, California, and Texas. 71% of their NOI comes from U.S. malls and outlets, but they also have an international presence that makes up nearly 10%. In 2022, the company saw their portfolio NOI grow 5.7%, with the domestic property NOI growing 4.8% year over year. Here's a look at Simon Property Group's top inline tenants, as well as their top anchors. As you can see, only one single tenant accounts for more than 1.7% annual base rent, and that is the Gap. So no real single tenant exposure that truly threatens SPG. For years, SPG has been known to have a fortress balance sheet, and that continues to be the case here in 2023. The company maintains a fixed charge coverage ratio of 4.8 times, with 6.7 years remaining on their debt on weighted average terms, with a low, very low payout ratio of less than 60%, suggesting the dividend is plenty covered. Speaking of the dividend, Simon Property currently pays an annual dividend of $7.20 per share, which equates to a high dividend yield of 5.7%. The company had to cut their dividend at the start of the pandemic to preserve cash, but has been aggressively increasing it ever since. Investors saw nearly a 27% dividend hike in 2021 and a 9.1% dividend hike in 2022. The valuation also looks quite intriguing here, as the stock currently trades at 11.3 times forward AFFO multiple, which lags their historical 5-year average of 13 times. Before we move on to the next dividend stocks to buy in the month of March, here's a quick word from today's sponsor. Today's video is sponsored by Moomoo. Moomoo is a great platform with many great tools for investors of all different levels. They have tons of information. If you're looking for dividend information, you can find that right with the touch of a button on their Moomoo app. In addition, ChatGPT has gone viral recently, and if you're looking to research stocks in the AI industry, Moomoo's ChatGPT concept feature has got you covered. Simply type ChatGPT in the search box to access the performance of ChatGPT stocks and any related stocks. And right now, Moomoo is offering a big promotion. If you open a new account and deposit $100, you can snag up to 7 free stocks, including 2 free shares related to AI-related companies. And if you deposit $1,000, you could be eligible to receive up to 17 free stocks with this promotion. But hurry, this exclusive and limited time offer won't last forever. Click down on my link down in the description below to learn how you can claim your free stocks today. Now back to our video where we are talking about the top dividend stocks to buy in the month of March. Moving on to number 2, that is Home Depot, stock ticker HD. Home Depot is the leading home improvement retailer here in the United States. The company currently has a market cap of $301 billion. Home Depot recently released their Q4 and full year 2022 earnings that saw the company miss on revenue and, more importantly, same-store sales decline, which was the first time the company has seen a decline since Q3 2019, which is quite a feat if you ask me. Other areas I look at closely when dissecting the Home Depot earnings report is their average ticket and their number of transactions. The average ticket can tell you if large dollar products are being spent, but it can also get confusing in the fact that inflation could play a large role in why average ticket may be higher, and less about customers buying more. That leads me down to the number of transactions. This cannot hide any of that. Are customers showing up and buying stuff? Yes or no? It is what it is, and it is answered by looking at the number of transactions. So if we look at both of these for the fourth quarter, we can see that the average ticket was $90.05, up 5.8% year over year. In terms of the number of transactions, they saw 378.5 million transactions, which was actually down 6% year over year. So this tells me that inflation had a bigger take with the average ticket moving up and less customers were showing up in terms of transactions. In addition, the management provided 2023 guidance that showed comp sales to be flat on the year. They also noted that operating margin would drop to 14.5%, largely due to a $1 billion investment they are making in their frontline workers. Analysts were looking for 15.1% operating margins. All in all, shareholders were not pleased and worried about the near-term growth for a company like Home Depot, especially with the slowing real estate sector in general and the uncertainty in the U.S. economy. As such, shares retreated nearly 8% following this report. Now, as you know, I am a long-term investor, and when I see stocks like this have huge red days, I want to take a second look because Home Depot is a great company, and they are one of the most efficient. I call them the gold standard on the market today. And with the guidance that the company showed being flat, this could be an opportunity. Knowing that there's uncertainty in the economy moving up, could this be an opportunity for Home Depot to lower the bar just to beat that by the end of the year? That could be a potential idea. But all in all, we are talking about one of the most efficient companies on the market today. With the drop in shares of Home Depot after the earnings report, shares have now fallen nearly 15% over the past 12 months. One thing that hasn't dropped has been the company's dividend. Home Depot has been a dividend growth machine over the years. Home Depot pays an annual dividend of $7.60 per share, which equates to a 2.4% dividend yield. An okay yield, but the dividend growth is where it's at. Over the past 5 years, Home Depot has increased their dividend at an average annual rate of 16.4%. And they have increased that dividend in general for 13 consecutive years and counting. Now to valuation. Shares of Home Depot currently trade at a forward price to earnings multiple of 18.4 times. Over the past 5 years, shares of Home Depot have traded closer to a multiple of 21.5 times. So to get a discount on a company like Home Depot with a strong balance sheet, a great management team, that is not an opportunity that comes around all that often. The The third dividend stock to buy in the month of March is Visa, stock ticker V. Visa operates out of the financial sector as one of the largest credit card companies on the market today. The company has a market cap of $454 billion. Over the past 12 months, shares are essentially flat, largely due to the good start to the year Visa has had, as shares are up 6% in 2023 alone. As we have seen over recent months, consumer debt has skyrocketed to levels last seen in 2008, and we all remember what happened in 2008, the Great Recession. Interest rates are rising, inflation still very high, and the U.S. consumer, once thought to be strong and working through this, is beginning to weaken. Household debt has reached $15 trillion and surged nearly $320 billion in the last 3 months of 2022 alone. And as you can see from this chart, it is not all related to housing debt either. Now looking more directly at credit card debt, we are now seeing that at record highs, just shy of $1 trillion here in the US alone. The $130 billion gain from prior year is the largest one-year gain on record according to the New York Fed. Due to the Federal Reserve rising interest rates over the past 12 months, this has a direct impact on credit card rates as well, which we have seen at 37-year highs, with rates nearing 20%, the highest level since 1985. All of this means products that the likes of Visa offers is seeing their cards being swiped more and more lately. In addition, outside of the slowing US economy, or global economy for that matter, we are also seeing consumers and businesses move to a more cashless society, depending even more on credit cards. Visa has a great business model that turns strong operating margins. The company generates an operating margin north of 60%, converting roughly 50 cents of every dollar they generate into free cash flow. And being a dividend investor, you know I love free cash flow. Speaking of the dividend, Visa is not known as much for their dividend yield. You are not really investing in Visa for the income. Instead, you are investing in the strong business, which can provide strong share price appreciation over time and very strong dividend growth that can compound your wealth over time. Visa pays an annual dividend of $1.80 per share, which equates to a dividend yield slightly below 1%. However, over the past 5 years, we have seen the company increase the dividend at an average annual rate of 18.2%. The past 2 years alone have included dividend hikes of 20% and 17%. The company also has paid a growing dividend for 14 consecutive years. In terms of valuation, analysts are looking for adjusted EPS growth of 13% this year, which equates to a forward price to earnings ratio of 26 times. Given that growth potential from the stock, the multiple tends to be higher. Over the past 5 years, shares of Visa have averaged a multiple of 34 times, and over the past 10 years, closer to 29 times. So trading at a discount regardless of the time frame you want to look at for shares of Visa. The fourth and final stock on our list today for the top dividend stocks to buy in the month of March is Johnson & Johnson, stock ticker J&J. As you know, Johnson & Johnson is a healthcare conglomerate. Johnson & Johnson currently has a market cap of $411 billion. Over the past 12 months, shares are down 2%, but as you can see, much of that damage has come in 2023, where shares are down 12% thus far. I will talk a little more about that in a second. The company currently operates in 3 operating segments. You have the consumer health segment, the pharmaceutical segment, and the medtech segment, formerly known as the medical device segment. Notice that I said currently. These are currently the company's operating segments. And the reason I say that is by the end of this year, in Q4 2023, the company will be spinning off its consumer health segment into a brand new company called Kenvue. And the consumer health segment is something you are more familiar with, as they have many household products with the likes of Tylenol, Motrin, Zyrtec, Band-Aid, Johnson's, Neutrogena, Aveeno, and many more. Being that the company is going to be spinning off the consumer health into a brand new company, current shareholders of J&J will also receive a piece of that new company. And we've already heard that that new company will also pay a quarterly dividend. So what will this spinoff do for post Johnson & Johnson, which will contain the segments of pharmaceutical and medical device? Well, the thing with both of these segments is they are much faster growing segments. So I see this playing out a lot like that of Abbott Labs when they spun off the likes of AbbVie. J&J recently reported their full year 2022 earnings that showed the company generated nearly $95 billion in sales, a 1.3% increase year over year. Looking at the adjusted operational sales by segment, pharmaceutical and medtech segments reported growth of 6.8% and 6.1% respectively, with the consumer health segment reporting 3.9% growth from an adjusted standpoint. The drop in shares of J&J we have seen in 2023 is providing a buying opportunity for long-term investors. Shares are trading at 15.1 times 2023 earnings, which is well below the company's 5-year average of 17.2 times. In terms of the dividend, Johnson & Johnson pays a very safe dividend of $4.52 per share, which equates to a dividend yield of 2.8%. The company has increased their dividend for 60 consecutive years, making them dividend royalty and known as a dividend king. And they have a 5-year dividend growth rate of 6.1%. Johnson & Johnson has actually paid a dividend since 1944, amounting to nearly 80 years of dividend payments. So there we have 4 high-quality dividend stocks that are trading at great valuations for you to take a closer look at in March 2023. All of these companies have great management teams, and they've had some trying times more recently. Home Depot with their earnings report, Johnson & Johnson with the spinoff and their earnings, as well as a lot of legal troubles they're going through also with the company, providing opportunities in these high-quality companies. They don't come around all that often, so make sure you take a second look at these 4 companies. Down in the comments section below, let me know which of these 4 you like best here in the month of March. And if you haven't done so yet, make sure you smash that like button down below and also check out the special promotion being done by Moomoo right now. Thanks for watching today, and we'll see you in the next video. Take care.